I've spent 30 years working on Wall Street in investments. And when I started in this business, we had 30-year interest rates were 7%.
Oh my, really?
Right? So yes. Now, will they go back to those types of levels? I don't think so. It'll be hard for longer-term interest rates, like the 30-year Treasury, to go below 3% in an environment where inflation will probably be 2.5–3% at some point. If you're a Korean investor and you own U.S. Treasuries, remember you're taking currency risk. So you're also making a big play on the dollar.
Taking your advice, we should take the hedged one, right? 많은 분들이 미국 금리 방향에 대해서 지금 굉장히 궁금해 하시고 있을 것 같아요. 저희 30년 국채에도 많은 분들이 투자를 해주고 계시고, 그래서 저희가 앞으로 도대체 이 금리 방향 어떻게 튈지 이런 것들 궁금증을 해소하기 위해서 여기 뉴욕의 블룸버그의 Ira Jersey를 모시고 한번 앞으로 금리 방향이나 장기 국채 투자 전략에 대해서 좀 심도 있는 이야기를 나눠보고자 합니다. So, hello Ira.
Hi. Thanks for having me. I'm Ira Jersey. I'm the Chief U.S. Interest Rate Strategist for Bloomberg Intelligence. Bloomberg Intelligence is the research group within all of Bloomberg and the whole infrastructure. I've spent 30 years working on Wall Street in investments. My longest part of my career was as an interest rate strategist at Credit Suisse, where I was for about 15 years.
Then I found the perfect man to actually speak to. So maybe before we get into heavy stuff, I'm curious, what kind of questions do you get a lot these days? Because I think our Korea investors will be curious about it.
Given the uncertainty with what's going on with the U.S. Fiscal situation and tariffs and the international situation in the U.S., we get a lot of questions about that. So there are a lot of investors from outside the United States who own Treasury securities. Is the U.S. debt sustainable? So U.S. debt to GDP now is about 100%. So the debt is about the size of the U.S. economy on a yearly basis. And people are worried that if the deficits continue to grow, that the U.S. will one day default on its debt. So people ask that all the time. I mean, the answer to that is no. There's other countries that have even more debt than the United States and have even lower interest rates.
I mean, you just mentioned about the debt ratio, like the 100%. By looking at the market for over 30 years, what's the level like?
Well, it's been growing. I mean, the last time that we had debt of this size was in the 1950s, after World War II, during the conflict in your country. And the debt went down quite a lot in the 1950s and 60s, and it didn't start to really go up again significantly until the 1970s. Now, it's grown very quickly since the global financial crisis. You had multiple fiscal stimulus plans, you had tax cuts, and then on top of that, additional spending that occurred during the Biden administration that has caused the debt to become as large as it is, almost 30 trillion US dollars.
I actually wanted to, give this question on behalf of my Korean investors. Is that actually, like many Korean investors, we have put in a lot of money on our 30 U.S. Treasury ETFs with the expectations that the rates would go down, and a lot, majority of the investments came in from 2022. But before expecting the direction, actually, whether the rates will go down or not, why do investors should consider maybe the long-term U.S. bonds as a component of portfolio? Do you have any opinions on that?
Well, there's a few different pieces. So where do bonds in general fit into an overall portfolio? So I think that's the question you're answering. Well, it is a balancing part of the portfolio. So you've seen this in recent weeks where when risk assets, so things like Bitcoin or stocks or some commodities, when they go down, the treasury market usually rallies. So interest rates go lower, the price of those securities go up. So it's a balancing factor. So most investors, if you have a moderate risk tolerance, you're going to have bonds as part of your portfolio. Now, how much depends on how much risk you want to take. And owning long end treasury bonds isn't riskless. And what do I mean by that? I mean, there is some risk in it because if interest rates go up, the price of those bonds can go down pretty substantially. So our view in the longer term, so let's say the next 5 to 10 years, is that interest rates are not going to go back to where they were in 2019 or 2021. But they could go down to, say, from 4.5%, a range where 30-year treasuries are now, maybe to 3.5% at some point, and then maybe go back up even higher in the longer term, because the economic environment has significantly changed. Part of it may be because of what's going on with the deficit, but more importantly, we are in an environment where inflation's likely to be higher than it was in the 2010s. You don't have the financial problems that we were dealing with back a decade ago. So in general, we think that we're in a more what I would call normal interest rate environment. So say an environment like we were in the 1990s or the early 2000s.
Yes. I mean, like for the past decade, like we have gone through very, very ultra low rate environment, but like a rapid increase after the COVID. And many expected reversal because I want to tell you, like people tend to predict future based on their own experience. And by when I actually started my career, it was like really extremely low. Yeah. And that was the time actually I remember. And like for my generation, we think the rates is too high at the moment.
So I've been doing this for a generation and a half.
Sure.
And when I started in this business, we had 30-year interest rates were 7%.
Oh my, really?
Right? So yeah, so if you go back and you go back to where some bonds that are maturing today, they have coupons, so the interest that's been paid on them since they were issued back in the mid 1990s were 7 and even a couple or 8%, right? So interest rates have been higher in history. Now, will they go back to those types of levels? I don't think so. But I think there is a risk that you wind up seeing interest rates even higher than where we are today over the next 5, 10, 15 years. We have to keep in mind that interest rates are sensitive to a couple of different things.
Yes.
Number one is growth. So just is GDP growing? Are people spending money? Are wages going up? And all of those things are currently happening in the US. Now it's slowed from where we were in 2022 and 2023, but we're still seeing decent economic activity for the moment in the United States. Now that can certainly change. On the other side, we also have inflation that's been somewhat stickier. So when you mentioned, when you started, when interest rates were low, we also had in the US in particular, inflation that was very low. So we had prices that were growing on an annual basis of only 1% or 1.5%. Now, today, we're probably likely to go back to where we were prior to the global financial crisis, which means that you have inflation that's between 2 and 3%. So that becomes your floor for how low interest rates can go. It'll be hard for longer term interest rates, like the 30-year treasury, to go below 3% in an environment where inflation will probably be 2.5–3% at some point.
So maybe you mentioned what actually affects affects the rate. So beyond traditional drivers like inflation that you just mentioned, are there new factors investors should keep in mind nowadays, when evaluating U.S. Treasuries?
Yeah. So one is certainly how much supply there will be, and what I mean by that is the U.S. government and most governments around the world, they issue bonds. So they issue it to the public market. And the U.S. Treasury has a choice of what maturities of bonds and other debt that it issues. So it could issue more T-bills, which it has been doing more recently. T-bills are under 1 year, so a lot of 3-month and 6 month, we call them money markets, so they're money-like instruments. But they could decide to issue more 30-year debt. And if they issue more 30-year debt, that's more supply, and basic economics would tell you that interest rates might go higher, prices might go a little lower if the government decides that it's going to issue more 30-year debt. We don't think that the U.S. government at this point has to issue any additional or change the way it's been issuing until probably early next year, and then they'll have to increase debt. So when that occurs, that's something to look out for. That's a risk. They do it once a quarter. It's called the quarterly refunding announcement. The two to look out for when they might change are November 2025 or February of 2026.
So how do you actually think about current political uncertainties actually affecting the Treasury?
Well, if you're thinking about 30-year debt, you should have a 30-year time horizon. I think that there's a lot of noise, right, and coming out of Washington right now, certainly there's a lot of uncertainty that's creating, and that is having an effect on consumer confidence, on business confidence. You see it in a lot of the data. That being said, and that's what we call the survey data, or I call it the soft data. If you look at the hard data, so things like consumer spending, the job market, wages, and how much wages are growing, so actual data that you can see on a month-to-month basis, that is still relatively strong at the moment as we speak here at the beginning of April, right? Now, that could change by June or July very quickly. But for the moment, those hard data are keeping up. So people are worried and nervous, but people are still acting normally when it comes to the economy as a whole.
I mean, throughout your career, when was the time the uncertainty issue was like the most high? Like
2008, for
2000,
sure.
yeah, for sure.
Absolutely, 100%. It was the fall of 2008, so September, when Lehman Brothers went bankrupt, when I had covered Fannie Mae and Freddie Mac right before they went into conservatorship. That was part of my job as a rate strategist back during that period of time. And you know, that was as close as we've come to the financial markets just completely seizing up. And I think it's underappreciated by a lot of people who weren't in the business how close the world came to really having another Great Depression type of event.
Wow.
We came within weeks probably of that occurring. So that was by far the most uncertain. I think today there's a lot of uncertainty because there's a lot of headlines and there's just a lot of different information, right? So none of which in particular is a massive game changer for the world. Even the tariffs for the U.S. economy. The U.S. economy is not a very big exporter or importer compared to most other countries, right? As a share of GDP, exports and imports in the U.S. are very small. Just consider this: only about 20% of the U.S. economy is actually goods. So of any type, that's gasoline, that's automobiles, that's going and buying a toy for your child. All of those things are only 20% of the U.S. economy. Most of the U.S. economy are services, and services are by definition domestic, right? Like, yes, you need some goods to do a service, right? You need a computer, you need other things like that, right? You might need a car if you're a delivery person, but those services have to be done domestically. So the U.S. economy is very domestically focused, and most of the growth has come from that services sector, actually. The goods sector in the U.S. over the last couple of years has actually been in a recession. And I think that most people don't realize that. And maybe that's one of the reasons why the Trump administration wants to focus on goods, because of the problems that the U.S. manufacturing sector has had over the past few years.
Interesting. I haven't thought about that part, actually. So I mean, Ira, it has been a very insightful discussion. So before we kind of wrap up, like, what's your one key takeaway for global investors, or maybe to Korean investors, that you would like to highlight as a bond player?
Well, I think first, and something we didn't touch on, is if you're a Korean investor and you own U.S. Treasuries, remember you're taking currency risk. So you're also making a big play on the dollar. So you have to be comfortable with your dollar exposure as well as how you think the bond market's going to do. So just keep that in mind when you're making your investments.
Sure. Actually, we do have like a hedged version and then unhedged version, and we also have like a Japanese yen open version here as well. So taking your advice, we should take the hedged one, right?
Well, so I think at this point, the U.S. dollar has been very strong, and certainly our view is that with what's going on with the tariffs, that the dollar could actually see some weakness here. And my colleagues who cover foreign exchange do think that the dollar is probably in for a either unchanged or maybe weakening over the next couple of quarters.
I mean, thank you so much for your time. I hope this conversation will be very helpful to our clients as well.
Well, thank you. It was great to talk to you.
Thank you.